Your 40s are supposed to be your financial prime. And statistically, they are peak income, peak assets, peak career leverage. That's also exactly why they're the most dangerous decade most men never see coming. Because the traps that destroy wealth in your 40s don't look like traps. They look like success. They look like a bigger house, a better car, a vacation that seemed reasonable given how hard you've been working. They look like being a good son, a good father, a good provider, all at the same time, while quietly hemorrhaging the compounding years you can never get back. I want to talk about 4 specific mechanisms that financially gut men in their 40s. Not vague advice about spending less. Specific, documented, data-backed traps with dollar amounts attached. And I want to start with the one most people talk about last because it's the most insidious, which means the 4th trap I cover today is the one that will hit you the hardest. I've seen this pattern enough times now that it's stopped surprising me and started just making me tired. Think of your 40s like a pressure cooker. The income is real, the assets are real, the optimism is real, but the pressure building from 4 directions simultaneously, lifestyle, family obligations, institutional fees, and systemic risk, eventually finds the weak point. And when it does, it doesn't just slow you down, it resets you. That's the metaphor I'm going to keep coming back to, the pressure cooker. Because everything in your 40s looks fine from the outside, and then the lid comes off. Let's start with the trap that's happening to you right now, whether you know it or not. Your income in your 40s is almost certainly the highest it's ever been. According to the Bureau of Labor Statistics Consumer Expenditure Survey, households where the reference person is between 45 and 54 spent about $100,327 in 2024. $100,000 in annual spending. That's the average. And here's the problem. That number has been climbing for 3 consecutive years faster than income. In 2024, 32% of adults said their family's monthly income increased from a year earlier, while a higher 37% increased their monthly spending. And this is the 3rd consecutive year that the share of people who increased their spending was higher than the share who increased their income. Think about what that means over a decade. Every year, you're spending a little more than you're earning in new income. The gap is small. It's almost invisible. That's the design. There's a name for this: lifestyle inflation. But the word inflation undersells it. Inflation suggests a passive economic force. What's actually happening is an active psychological process. When your income rises, your reference point for normal rises with it. The apartment that was fine at 32 is no longer acceptable at 44. The car you were proud of at 38 needs an upgrade at 45. The vacations that felt luxurious at 30 feel like baseline expectations at 47. You're not being irresponsible. You're being completely rational within the logic your brain has constructed. That's the trap. A guy I heard about mid-40s, 2 kids, software director, making decent money, tracked his expenses for the first time at 46. Not because he was broke, because he felt like he should be further ahead. He made more money at 46 than he had ever made in his life. And he had less liquidity than at 38. More assets on paper, sure. Equity in the house. Higher 401k balance. But the actual margin, the free cash flow he could redirect toward building wealth, had quietly shrunk over 8 years of incremental lifestyle upgrades, each one defensible, together devastating. Here's a framework for thinking about it. There are 3 levels of financial awareness in your 40s. Level 1 is you know your income and you know your big expenses. Most people live here. Level 2 is you track everything and you understand where money actually goes. Very few people do this. Level 3 is you understand the compounding cost of each spending decision, not in this year's dollars, but in retirement dollars 25 years from now. Almost nobody operates here. And that gap is where wealth evaporates. Because here's the number that changes the conversation. Take an investor who starts with $100,000, contributes $1,000 per month for 40 years, and earns a 9% annual gross return, roughly in line with long-term US stock market averages. With no fees at a 9% compounded return, that investor finishes with $7.2 million. Now add a 1% financial advisor fee on top of a 1% actively managed fund expense ratio. Net return falls to 7%. you finish with $3.9 million. Total damage, $3.3 million. $3.3 million. That's not an error. That's not a rounding issue. 2 percentage points of annual fees, compounded across 4 decades, turn a $7.2 million retirement into a $3.9 million retirement. That is roughly half the eventual portfolio vaporized by a charge most clients accept as the normal price of doing business. And before you think this is a fringe case, the average all-in cost for a managed portfolio, including investment management and fund expenses, runs about 1.52% annually. Most men in their 40s have a financial advisor they trust. They met at a party, or through a referral, or they responded to a mailer. The advisor is nice, the quarterly calls are reassuring, and the fee is just 1%. Here's what makes AUM fees different from almost any other professional fee you'll ever pay. They compound against you. Every dollar taken in fees is a dollar that can no longer grow. The true cost of a 1% fee isn't just $200,000 calculated as 1% of $1 million times 20 years. When you include the loss compounding on that extracted money, the real number is $663,000. The pressure is building, but stay with me, because in a few minutes I'm going to explain why job security in your 40s is a much more fragile thing than most men believe, and the data on that should change how every decision you make in the next 5 years feels. But first, the second trap, and this one doesn't announce itself at all. More than half of Americans in their 40s are balancing care for both their children and their senior parents simultaneously. This is called the sandwich generation, and the name is accurate in a way that almost feels too on the nose. You're in the middle. You're absorbing pressure from 2 directions at once. And men specifically are the ones most likely to feel this as a financial squeeze. The burden differs by gender. Men report greater financial pressure, while women are more likely to bear the emotional and physical toll of caregiving. In total, 69% of respondents said they feel financial pressure from caring for parents, up from 64% in 2022. That trajectory matters. It's not staying flat. It's climbing. And it's going to keep climbing as the baby boomer generation moves deeper into its mid-70s and 80s, while their children, US, are still carrying mortgages and paying for college. On average, sandwich generation caregivers spend about $10,000 per year on caregiving expenses, which can affect long-term financial stability, including retirement savings. $10,000 a year. That's $830 a month. You're probably not tracking as an investment cost because it doesn't feel like a financial decision. It feels like love. It feels like duty. It is both of those things. And it is also financially the equivalent of $830 a month that is not going into a compounding account. American families also spent an average of $30,837 on college last year, a 9% increase from $28,409 the year before, according to Sally Mae. So if you're in your 40s with a kid heading toward college in the next 5 to 8 years, and a parent whose health costs are climbing and your own retirement account is still catching up, welcome to the pressure cooker. You are now simultaneously trying to fund 3 financial futures with 1 income stream. Among adults ages 40 to 59 with at least 1 grown child, 73% say they have provided financial support in the past year. 73%. That's not helping a kid move. That's ongoing financial support. Adult children who graduated college and still need a supplement. A daughter who moved home after a breakup. A son whose startup didn't raise the round. You don't say no to these things. And the financial system has no product to sell you that accounts for them, because the financial system wants to pretend these things don't happen. By the way, hit subscribe if you like the content, otherwise YouTube's algorithm may never show you my videos again. Now the pressure cooker is full. And this is where it gets really interesting, because I haven't told you about the trap that statistically has the highest probability of happening to you and the highest financial impact when it does. And it is not what you think it is. Here's the honest part of this that never makes it into a retirement calculator. Knowing these numbers matters, but that's the first step. The second step is building a system around them. And I built a book called The Exit Code specifically because those 2 things are not the same. Knowing your 401k balance and understanding when you can actually stop working, those are completely different problems that require completely different math. The exit code is an analysis of 50 years of retirement data distilled into a mathematical framework. It's 8 chapters of pure research, no filler, no inspirational quotes, 2 of the things I cover that connect directly to what we're talking about in this video. The 58% rule, which is the documented probability that any worker over 50 will face some form of involuntary job separation before they plan to retire, and what the buffer strategy looks like if you know it's coming, and the 4% trap, because the traditional 4% withdrawal rule that every financial advisor recites was built on data from a very specific market period, and applying it without adjustment to modern conditions creates a false sense of security that burns retirees in the first decade. The dynamic withdrawal method I cover in that chapter is what actually works. You can get the exit code through the link in the description. It costs less than a dinner out, and it will give you a more honest picture of your actual retirement math than most 1% a year advisors will. Now let's talk about the trap that hits hardest. You think the biggest financial risk in your 40s is market volatility. You think it's making a bad investment. You think it's getting laid off. All of those are risks. None of them are the leading cause of catastrophic wealth destruction in midlife men. The number one cause is relationship dissolution. And the reason it doesn't get discussed clearly is because the financial industry is deeply uncomfortable with it, and the self-help industry treats it as a personal failure rather than a financial event. According to research published in the journals of gerontology, both men and women experience roughly a 50% drop in wealth following divorce. Not a reduction, a halving. Men see a 21% drop in their standard of living after gray divorce, while women experience a 45% decline. Men lose less in living standard, on average, but they lose more in certain categories. The house, the retirement accounts, the asset base that was quietly building for 20 years. The median cost of a divorce in the United States in 2024 is $7,000, according to Forbes. However, the average cost is $15,000 to $20,000, and highly contested divorces can cost significantly more than $100,000. And that's just the legal fees. That doesn't include the duplicate housing costs you're now running 2 households, the child support or alimony that extends for years, the refinancing, the therapist, the tax bracket change that hits when you go from married filing jointly to single. You are now a single tax filer as opposed to married filing jointly, and that change alone can move you into a higher marginal rate on the same income. There's a story that illustrates this better than any statistic. A man, call him David, ran a small construction business in the Midwest, built it from nothing, spent his 30s working 7-day weeks, hit his mid-40s with the company at a solid $4 million in annual revenue, a nice house, in a retirement account with $200,000 in it. His kids were 12 and 15. His marriage had been under strain for years. Both him and his wife knew it, but he always said, "We'll sort it out when things slow down." Things never slowed down. The divorce at 47 cost him the business itself because the business was a marital asset. His ex-wife received half its appraised value. The retirement account was split by a qualified domestic relations order. He walked out of a 20-year marriage at 48 with roughly 30% of what he thought he had built. Not because the system was unfair, because he never modeled the scenario. He never stress tested the financial plan against the possibility that his marriage might not last forever. This is not about whether divorce is the right decision. That's not my lane. What I can tell you is that statistically, around 40% of today's marriages will end in divorce, with the average US marriage lasting about 19.9 years. 19 years. If you got married at 28, that statistical endpoint lands you squarely in your late 40s. And the peak earning years of your life become the years where you're dividing everything you accumulated and starting over with half the asset base and all of the same obligations. The financial preparation for this risk is not cynicism, it's engineering. Keep separate financial tracking. Maintain your own credit history. Understand jointly held assets and their split structure. Not because you expect it to happen, because 40% is not a fringe probability. Now here's where the pressure cooker delivers its final surprise. And this one permanently changed how I think about career risk. You think the risk to your financial plan is market volatility, or a bad real estate purchase, or the fee drag we talked about earlier. Those are real. But the single most documented wealth-destroying event for men in their 50s, which starts building in their 40s, is involuntary job separation. And the statistics on this are quietly stunning. According to a study by ProPublica and the Urban Institute, which analyzed data from the Health Retirement Study, 56% of workers 50 and older get laid off or leave work involuntarily. More than half. A 2018 Urban Institute analysis of full-time workers in their early 50s found that 2 out of every 3 eventually left their jobs involuntarily, with 56% citing employer-related reasons such as layoffs or business closings. The plan was to work until 65, to contribute maximally in the last 20 years, to build the compounding base that makes up for the uneven contributions of your 30s. And then the company restructures, or AI makes your role redundant. Or they decide your salary, which reflects 30 years of expertise, is no longer justified when they can hire someone 27 years old for 60% of the cost. AI is rapidly changing many types of roles, and some firms believe that younger workers are more willing to embrace those changes. As AI transforms those roles, some older employees find that their deep experience is no longer particularly valuable. The median household income for people over 50 fell 42% after getting laid off, according to the Health Retirement Study. Only 1 in 10 ever earns as much as they did before getting laid off. 1 in 10. Read that slowly. 9 out of 10 people over 50 who lose their jobs never return to their prior income level. Not take a while to recover. Never. The income is permanently reduced. And the window to fund the retirement account, the window everyone relied on, closes early. According to the Bureau of Labor Statistics, job seekers aged 55 to 64 spend about 26 weeks on average looking for a new position, nearly 2 months longer than job seekers in their late 20s and early 30s. Think about what 26 weeks of job searching looks like financially in your late 50s. You're burning through savings that were supposed to compound. You're potentially pulling from the 401k early, triggering penalties and taxes. You're stopping catch-up contributions at the exact decade when they're most valuable. While 40% of men retire at age 67 or later, planning on extended work is a risky strategy, as many people retire before age 65. As of September 2025, 48% of Americans in their 40s and 44% of those in their 50s say they lack confidence that their savings will last through retirement, or believe they may not be able to retire at all. According to the Pew Research Center, nearly half. And this is the group that on paper looks like they're doing fine. They have jobs, they have 401k accounts, they have home equity. They look fine from the outside. And the pressure cooker is 3/4 full. Here's what makes this specifically cruel. The career peak for most men happens between 40 and 55. That's when the title is highest, the salary is highest, the influence is greatest. It is also when the company has the most financial incentive to replace you. Senior people are expensive. They're not always as nimble on new platforms. They push back in meetings. They have opinions. Companies often want to know how long an older job candidate realistically wants to keep working. Not a question candidates in their 30s or 40s are typically asked. So you arrive at 45 thinking you have 20 more years to build. Statistically, you have somewhere between 10 and 15. That's the number you should be building your financial plan around. Not 65, not the number in the brochure. Let me give you a mini case study that makes this concrete. Mark is 43. He earns $140,000 a year as a senior project manager at a mid-sized manufacturing company. He contributes 8% to his 401k, enough to get the employer match, but not more. His balance is $220,000. His wife works part-time. They have 2 kids, 13 and 10. His mother is 71 and recently had a health event that required him to increase the time and money he puts into her care about $800 a month currently, likely more within 2 years. The house has $400,000 in equity. He has about $30,000 in liquid savings outside his retirement account. On paper, Mark looks fine. He doesn't feel fine. In 2024, 32% of adults said their family's monthly income increased, while 37% increased their monthly spending. Mark is in the 37%. He upgraded the car 2 years ago, added a streaming service, renovated the kitchen. Each decision was reasonable. Together, his savings rate outside the 401k is effectively zero. Now apply the fee drag. His 401k is in a target date fund managed through a financial advisory relationship his company set up. The all-in expense ratio is 1.4%. This number looks small, but could shrink his investment value by almost $1 million over 30 years compared to investing without fees. Mark has never looked up the expense ratio. Nobody told him to. Now apply the sandwich pressure. His mother's care costs are going to grow. His kids will be in college simultaneously in 5 years. College costs climbed 9% last year to an average of $30,837 per year per student. 2 kids in college at the same time, that's an additional $60,000 a year in potential obligations at exactly the moment he should be maximizing retirement contributions. And if the company restructures, which it has done twice in the last 8 years, and Mark finds himself in the 56% who face involuntary job separation after 50, the whole plan falls apart. Because the plan was never a plan. It was an assumption that the future would look like the present. It almost never does. But Mark can just find another job. Only 1 in 10 people over 50 who lose their jobs ever earns as much as they did before. 1 in 10. The other 9 take roles with lower titles, lower pay, lower benefits, and often no 401k match. The compounding years they needed are gone. There's a punchline to all of this that I want to leave you with. You know that phrase, fake it till you make it? The financial version of that in your 40s is looking successful while silently running a structural deficit against your future self. High income, high spending, fees you never audited, obligations you took on because they were right, not because they were planned for, a career cliff you never modeled, and a retirement account balance that looks impressive until you divide it by how many years you need it to last. The average 401k balance for people in their 40s is $370,879. But the median, the number that reflects what most people actually have, is $154,212. $154,000. Fidelity's benchmark is 3 times your salary by 40. At the median US salary, that means you should have roughly $250,000 in retirement savings by 40. The median is 40% below that benchmark. The pressure cooker is already running hot, and most men don't know it. Here are 3 things you can actually do about this. Not generic, not spend less, specific, calibrated to the 4 traps we just covered. First, audit your fee structure this week, not someday, this week. Pull up your 401k, look up the expense ratios on every fund, and add the advisory fee if you have one. Fees are the most reliable predictor of long-term net returns. If your all-in cost is above 75 basis points, 0.75%, you are paying more than you need to be. The difference between 1.5% and 0.1% in fees on $200,000 over 25 years at 7% growth is roughly $200,000 in lost compounding. Not spent, not lost in a crash, extracted quietly while you were on a Zoom call about Q3 projections. Second, build the forced exit scenario into your plan explicitly. Assume that sometime between age 50 and 58, there is a 56% chance your career will experience an involuntary interruption. That's not pessimism. That's the Urban Institute data. Model what your finances look like if your income drops by 40% for 2 years starting at 52. If that scenario makes you insolvent, you need a larger buffer. The 401k is not a buffer. The 401k is a retirement account. A buffer is liquid, accessible, and not penalized when you need it. Most men in their 40s have none. Third, track the sandwich generation drag explicitly. List every dollar that flows out of your household toward your parents and your adult or near adult children separately from your regular budget. Then calculate the compound cost of that sum at 7% over 20 years. On average, sandwich generation caregivers spend about $10,000 per year on caregiving. $10,000 a year, if invested instead at 7% for 20 years, becomes roughly $40,900 in future value. That's not an argument against caring for your parents. It's an argument for treating these obligations as real financial variables in your plan and sizing your savings rate accordingly rather than discovering the gap at 61. Your 40s feel like the summit, and for income, they usually are. But income and wealth are not the same thing. Income is the water going into the container. Wealth is how much is still in the container after the lifestyle, the fees, the obligations, and the disruptions have all taken their share. Most men in their 40s are running the faucet wide open and wondering why the container stays half full. The pressure cooker analogy only has one useful ending. You can relieve the pressure intentionally by understanding the four forces building simultaneously and addressing each one with a specific number and a specific plan. Or you can wait for the lid to come off. The first one is uncomfortable. The second one is expensive. Lazy investing built more fortune than crypto memes. And the guys who figure that out in their 40s rather than their 60s are the ones who look back at this decade not with regret, but with gratitude that someone made the math boring enough to actually be useful. As of September 2025, according to Pew Research Center, 48% of Americans in their 40s lack confidence that their savings will last through retirement. 56% of workers over 50 are forced out of jobs involuntarily, per research by ProPublica and the Urban Institute. Both men and women lose roughly 50% of their wealth in divorce, according to the journals of gerontology. 2 percentage points of annual fees, compounded across 4 decades, turn a $7.2 million retirement into a $3.9 million retirement, roughly half the eventual portfolio, vaporized by charges most clients accept as the normal price of doing business. The data is not trying to scare you. It's just math. And the math doesn't care whether you looked at it.